Welcome, everybody. Welcome back to today's session. This is the DanTrades Mentorship. We went for a break for 2 weeks and we are actively back once again. Um, I'm very happy. I'm very happy to continue what we're doing, helping each other to understand the Forex market. Today, we'll basically be talking about indicators. Today, we'll basically be talking about indicators. So sit tight and let's start in a jiffy. All right. So basically, today we'll be talking about forex indicators. They are very much very important. Now, before we even start, we have two types of forex indicators. We have the technical indicators and we have the fundamental or the economical indicators. Now, I want you people to pay very much attention to this. Forget about the slide and listen to what I'm saying attentively. Now, for the technical, these are tools that help you read markets better. Basically, you put it in your mind that they are going to help you read the market better. Both indicators are going to help you read the market better. But I'm trying to underline why we want indicators. They help you understand what's happening in the market better. Now, for technical indicators, they normally use past data or volume to show patterns. So with the technical indicators, you realize that we'll be talking about trend indicators, momentum indicators, and volatility indicators. What am I saying? Now, these indicators we've selected, some are going to help us know where our market is going. You know, we need uptrends and downtrends. We've already learned that in our previous session. Some is going to give us momentum. Now, you know that I told you that if you are trading, we need momentum. We need momentum so that we can win our trades early. If you're on the right side of market, your trades hit your TPs very quick. Now, so we are going to deal with trend indicators, which some of them are like the moving average. We are going to have momentum indicators, something like the RSI. We're going to have volatility indicators. So without quick to do, without much to do, let's go through forex indicators quickly. So what do we have here? It says forex indicators are tools that help traders study how price move in the market. They are your friends, but we are not going to focus most on forex indicators, but you need to understand what they are. So we have to go through this one by one. They show trend, momentum, and important economic changes. Now, the economic changes is coming from the aspect where I said we have two types, where we have the technical and we have the economical indicators. Now, these affect currency prices. Very important. Indicators affect currency prices, especially the economic ones. The economic ones, you have like NFP, CPI, GDP, interest rates. They all affect the forex market. So by using these indicators, traders can understand the direction of the market, how strong a trend is, when the trend might what change direction, and it helps them make smarter and more confident trading decisions. So that's basically forex indicators. We are helping ourselves get an edge to the market. We need these indicators to tell us what's going to happen. Is our trend correct? Are we in the right trend? Can we enter? Are we going to have momentum? Is there any changes to the economy? All that is dealt under forex indicators. Today is going to be a very quick session, not much to do. So technical indicators, exactly. I said we have two types. We have the technical indicators and we have the economic indicators. As I explained earlier, they normally use past data or volume to show patterns. So I said we are going to start with the types under. We have the trend indicators, we have the momentum indicators, and we have the volatility indicators. So as you can see, Technical indicators are mathematical calculation based on price, volume, or open interest. Simple and short. But how can we understand them deeper? So we have the moving average, it's a type of indicator. We have the RSI, it's a type of indicator. We have the MACD, it's a type of indicator. And we have the Bollinger Bands, it's also a type of indicator. Now, if you joined the previous sessions, I showed where you could find your indicators. Now, for those who have forgotten, let me make a quick recap. If you want to get your indicators on your chart, it's right on top by the time frames. So you have indicators right on the top. You click on it and you can search any indicator you want. That's simple. So you open your trading view where you trade, you go to where your time frame is on your left, indicators on your right. Sometimes you might not see the indicator's name because it's just showing just the sign, but that's the indicators. So that's basically it for the indicator. Yeah. Apart from that, we move on to the next thing. We have RSI, we have the MACD, and we have the Bollinger Bands. Now, I'm going to dive deeper into all of them, every single one of them. We'll be diving deeper into every single one of them. So let's dive into the moving averages. I think we didn't see the indicators aspect again, so I'll be going over it one more time. If you open your trading view, you get your indicators at the top corner just by your time frames. It's written in indicators. It has a tag indicators. You just tap on it and you have your indicators on your screen. As simple and short. Very simple and short. So that was it about the indicators aspect. We can continue. So, yes, as I said, we are going to be talking about moving averages, RSI, MACD, and the Bollinger Bands. Now, the Bollinger Bands was brought up by John Bollinger. That's why it's called the Bollinger Bands. But you realize the rest don't really have anything related to someone's name, only the Bollinger Bands. So, basically, that's basically it. So, let's continue. Um, Technical indicators. Good. Moving averages. Very interesting. Moving averages are very, very, very interesting sets of indicators. So, what does moving average do? The first thing is moving averages are there to smooth data to see the overall trend of your market. When I was listing the types of technical indicators, I listed moving averages under trend indicators. They help you smooth the data to know your trend of the market. We only use moving averages to know the trend of your market, as simple and short. Now, how do you do this? Moving averages takes a period of candles. So you can, if you choose an example, is if you choose the 50 MA, the 50 moving average, it's going to take data for the last 50 candles on whatever time frame you are on. So if you're on a 15 minutes time frame, it's going to take the last 50 candles for the 15 minutes time frame, 4 hour, last 50 for the 4 hour. That's how it is. It's going to take that and smooth it, give it a smooth line. Now, if your line is moving to the upside, of course, you know what it means. You're in an uptrend. If it's moving to the downside, you're in a downtrend. If it's moving sideways or in the middle, which is horizontal, then you should know that you are in a ranging market. And what do we do in ranging markets? We don't trade. It's as simple as that. There's no two ways behind this. It's very simple. Uptrend, downtrend, ranging market, we are out. We don't put ourselves in ranging markets. We don't put ourselves in that trouble. We don't want that kind of trouble. So that's basically it about the 50 moving average, or the 50 MA. And now we have two main types. We have the simple and we have the exponential moving averages. The simple is quite simple. So for the last 50 candles, the simple is going to take each price, add it together, and divide it by the total number of price. So if the total number of price was 50, it will take each price. Maybe the first price, the difference was maybe 20. The second one was 35. The third one was 44. It's going to add all of them and divide it by 50. Simple. It's going to take all of them and divide it by 50. That's the simple moving average. The simple moving average is basically like a mean. It's like a mean. So the simple moving average acts like a mean. So what does it do? It calculates the average price over a set period. Smooth and easy to understand. So let's see how it looks like a moving average. So I go to indicators. I've already started some of them. There's a moving average. So you can see the line, a very smooth line. I don't know which moving average is this. I don't know if it's a 50, if it's a 10. I don't know. If you right click on it, you can check. So let's right click on it. Good. Okay. So this is the 20 MA, the 20 moving average. So it's taking it over a period of 20 candles, 20 candles, 20 candles, 20 candles, 20 candles, and has given us this smooth line. Now, that's how simple the simple moving average is. But what's the exponential moving average? Now they are the same thing, but the difference is the exponential reacts to whatever new price you have. So the simple is for the last 20. No matter what this candle does, it's not really going to affect it that much because it's for the last 20. But for the exponential, if this candle gives a dip to this area, the exponential is going to react. The difference between the simple and the exponential is exponential reacts to current price movement as compared to the simple. The simple is going to use the mean or the average, but the exponential is going to react once price changes direction or does something fishy or does a dip or does a fly or whatever. So the difference between the simple and the exponential is the exponential uses a period of whatever you want to use. Let's say 20 period. It's going to take 20 price movements, the differences, and divide by the total number, which is 20. But exponential is also going to do the same thing, but has a reaction to current price. As simple as that. Has a reaction to current price. So what's as you can see, the simple says it calculates the average price over a set period, smooth and easy to understand. And the second one is exponential moving average. What does it basically do? It does the same thing, but newer price data has a strong influence on it. It's influenced by new price data. Traders use it when they want quick signals too. So the people who trade at 1 minute, the people who trade at 5 minutes normally use moving averages, but the exponential moving average. That's very clear. I hope it's clear. If you have any question in the comment section, like and subscribe if you are new here. Welcome to the DanTrades mentorship. In case you are new here, like and subscribe. So how do you use the EMA? We don't have to go over this. Let's just go straight to trading view and let's see how we can use this beautiful EMA. Now, anytime your price crosses your EMA, either to the upside or downside, it shows either a buy side or a sell side entry. So let's look at something quickly. As you can see from here, price crossed this EMA. After crossing it, it came to make a retest on the EMA and bought. So for those who trade only EMA, the bots, most of the bots people create online trade EMAs, they're going to do something like this. Put their stop loss right before the EMA and put their TP on the next candle. So you have something like this. And you get your simple 1:2.5. That's how plenty trend line indicator traders trade. Simple, very simple. No issue. You have no issue with anyone. You just put it on a retest and you go. So as you can see here, price crossed again, retest. You take your style, you put on the retest for the line, put it at where the last intersection happened, the high, and you move it to the next high, which is somewhere here. But you can't be trading 1.16 RR. So you can extend it a little to any of the highs to your left. There is one here. There's a low to your left here. There's another low to your left here. There's equal lows. We've spoken about equal lows. Price trying to return to equal lows in one of the sessions. Go back and go and watch that video. Every single video matters. Please, every single video matters. Very, very important. Every single video matters. Kindly watch the videos. They are going to help you a lot. Okay, when it's time for the source, I'm not going back. So that's it. You get your simple 1:3 or close to 1:4. You are gone. You have a cross. You look for the retest. There was no retest around here. the retest came here, and unfortunately you lost the trade. So you're not going to win everything straight for it. But what happened? It broke it. So you are waiting for a retest. You look for the retest on the line here. Here there is no cross. There's no major cross here. So you have to move it to the high here. You move it to the high here, and you look for the next low. You have a low here, but it's going to be small. You have another low here, which you can pick. There's a low you can pick and gives you a 1-2, and you're done. So out of this, you've won 3 trades and lost 1. Now with the 3 trades, you have 2 RR here. You have 3 to 4 RR here. That makes it 6, and you have another 2, which makes it 8. So 8, and you lost 1 RR. So that means 7 RR. So whatever amount you've been placing your trade with, in case it's $50, out of these 4 trades, you're going to get $350 in return. As simple as that. Forex is not that hard. If you try to skip the process, it's going to get very hard for you. If you try to skip the forex process, it's going to be very, very, very difficult. Please, any question, leave it in the comment section. I'm here for you. I'm going to give you a reply. So that's basically the moving average. We can move on to our next indicator. We are going to have the relative strength index. Now, relative strength index simply is for momentum indicators. It's for momentum. That's all. We want momentum. So, what are we um um what are we trying to see? So sometimes when we trade, we want to know how fast. It's not even about knowing how fast your trade is going to place or your trade is going to win. We want to know how fast price is going to move to a direction. So what does a relative strength index do? It shows if market is overbought or sold. Simple. It shows whether market is overbought or oversold. So when price tends to go to one direction for a long period of time, it tells us, oh, the market is overbought, the market is oversold. People will now try to do the opposite. So it's a momentum indicator, and it compares recent gains to recent losses. Let's go over the chart. It's simpler if you explain on the chart as compared to in words. So relative strength index, I go to my indicators. Let me turn this off first. Remove. I can remove this. Okay, I don't need to remove this. Indicators. Right now we are doing the relative strength index. Wow, such a beaut. So look down here. Now you can see it has 3 lines. It has a middle line, which is something like a balance line. It's called a balance line. It has the top line, which is for overbought, and it has the lower line, which is for oversold. What does this mean? It means that at a point in time, price gets overbought. The wins or the gains as compared to the losses becomes too much. Price has to restructure, or the loss compared to the gains become too much. The price has to restructure. So when the loss becomes too much for price to structure, it's going to give you an oversold. So you can see the loss here was quite too much as compared to previous price action. So if you look at previous price action from here going, you can see that it's something like a ranging market, but price all of a sudden sold too much or gave a loss too much in recent price action. So what happens? Market has to restructure and do what? Balance itself. So when market is oversold, price does what? It tends to buy. So as you can see, this line is for oversold, this line is for overbought. Price oversold went below the 30 mark. The 30 mark is for oversold and the 70 mark is for overbought. Went below the 30 mark, and what happened? Price reversed. So you don't just look at this and say, okay, because of this, that, I'm going to do this. Now, if you add this MACD to the previous one we did, which is the RSI, let me turn it on quickly. And look, Forex is a beautiful thing, to be very honest. Look at this. RSI. Good. So price hold here very strongly. Now, here said it's overbought around this area. Price tried to make another retracement. We didn't get a crossover our AMA. So we had a retest and price sold again. Now, price did a cross here. Now we had a cross here, and we also had and overbought here, that should tell us that we should be ready to reverse our market trend. As simple as that. Now, we sold here because we followed mainly our moving average. Now imagine you were trading, someone who not want the ones to do, someone who wanted to reach this low, you're going to hit your stop loss. The reason why we won this trade is because we chose to take our profit at the next low, which was around this area. That's one of the reasons why we won this trade. It's because we decided to take our profit at the next low. If we decided to take it at the low here, the ultimate low, we're going to lose the trade because now price is ready to buy. So we've gotten all over sold here. We are ready to buy. We are getting a confirmation here that price moved to the upside, has crossed the moving average. Price is going to retest and continue. But first, we failed the trade. Price came down and broke it one more time and did a retest. So now you're not going to get it straightforward. I told you you're not going to get 100%, but it's your win rate that's going to show. Put it at the low of the cross and target the high, which is here. And we're going to get a 1:2. Very clean. There's the high, there's another high, this high. You can target any of them, you can target this, you can target that. 1:2, and you're done. Simple, very beautiful. You have no issue with anyone. That's so simple. If you have any question, one more, the comment section, I'm here for you. The comment section, I'm here for you. Any question at all, I'm in the comment section. So that's the relative strength index. If you have overbought, you should be ready to sell. If you have oversold, you should be ready to buy. It helps you indicate, it helps you identify reversals. Very simple, very beautiful, and you are good to go. Now we have the MACD, or the moving average convergent divergent. Now, this MACD, simply put, it is two moving averages combined together with a signal line and a histogram. So again, the easier way to explain these indicators is by going straight to the chart. MACD is two moving averages with a signal line and a histogram chart. So how does this MACD look like? Let me take these off. Let me take these beautiful things off. So our MACD, good. I've started them, that's why they are here. You can search them here, and um, you can set them there and just start them. So this is your MACD. Your MACD also gives something like this thing forex trades. This is not the MACD I'm looking for. Coming. MACD. Hold on a minute. Let me get something. MACD. Moving average divergence. I think it's this. Not that. That's not MACD. Okay. I'll just explain with the earlier one. That that should be fine. So as I was saying, the MACD has two crosses. I don't know why none of these MACDs are showing the one I want. Oh, okay. This is an example of a MACD. Let me use this. Let me use this one for now. Um, Now, what do you see? You see two lines. One is the moving average, the comparison between the two, and this is the histogram. Now, what is this basically teaching us? So what it's saying is that it has a MACD line which is going to be comparing two EMEs. It uses EME, it does not use SME. They don't use the simple moving average, they use the exponential because they need reaction to price. You know, the people who use this MACDs are people who do scalping, people who do day trading. They want to get their trades quickly. It has a signal line, which is normally the 9-day moving average, and has a histogram. Now, the histogram is going to tell you the difference between the MACD and the signal line. So, if you look at, um, if you look at here, you can see that it's giving you a negative. Now, the blue line is the signal line, and the yellow one is the MACD line. So you see, when the blue line goes below the MACD line, it gives a negative. It starts giving a red bar, telling you that you're in the negative aspect. The blue crosses, you get a little green. Crosses down again, you get a red. It's telling you that right now your currency is going in the negative direction or going in the positive direction. So you can see how this place align perfectly. This could give you what, a third confirmation that you actually want to buy. Now, it gave you another confirmation here for buys after it got the overbought, after it got the oversold from the RSI. Forex is that simple. It's that simple if you understand the concept behind all the indicators you're using. Many people don't get the concept behind the indicators. When I started fresh, I never got the concept until few years back. I think last year, last 2 years, where I sat down to learn everything again, and I actually got what the indicators were doing. Yeah. But I personally don't trade with the indicators because I only use them to confirm what's happening, whether I'm the right direction or not. So it's not something I really rely on solely. Yeah. So that's it about the moving average. And the last one is Bollinger Bands by John Bollinger. Bollinger Bands. So what are Bollinger Bands? They are technical indicators that show volatility. I told you, we are talking about three types here. We are talking about the momentum, the trend, and the volatility indicators. Now, Bollinger Bands are a technical indicator that shows volatility and helps traders identify whether price is high, low, or breaking out. They consist of three lines. Straightforward, let's go into our chart. But first, the middle band is a 20 SMA. Yes, for Bollinger Bands, they use SMA. And the upper band is just a deviation, a standard deviation, and the lower band is just also a standard deviation. Now, standard deviations are the same values. It either goes up 1 or comes down 1, goes up 2, comes down 2. It's a set value. You don't have standard deviation to the upside, which is 4, and standard deviation to the downside, which is 3. No, they are set values. Standard deviations can be calculated mathematically. So their calculations, the solutions are there, the formulas to standard deviations are there, not really important. What is needed is the Bollinger Bands. Now, if you go straight to the Bollinger Bands, you realize that, let me close this beautiful thing. MACD, thank you. Remove. I have one here off. Good. So let's look at the Bollinger Bands very quickly. Very quickly. Time is much fast spent. We've already spent 30 minutes. I don't want the session to be more than 45 or an hour. So good. As you can see this, look at something. Everything is just funny. Look, if you have the 4 indicators together, this was a very massive trade. Look, simple average gave us this area, right? But look at what the Bollinger Band is doing. Bollinger Band retested its middle line, and boom, as simple as that. Bollinger Band is also giving us a confirmation. I remember RSI was also giving us a confirmation down there, telling us that we should be ready to sell. We are overbought. I remember. So look at this. The indicators work. You should just understand how to use it. Don't rely solely on it. The bots, we have HFT bots, we have scalping bots. They use this. They base on these instruments. That's why most of them are accurate, and they do it in shorter time. So if you realize, you see people online having bots that open trades very fast and close, open trades very fast and close. They deal on these simple indicators. Nothing else, nothing big, nothing much. They deal on these simple indicators. You have to be quick. You have to learn things fast. If you have a problem, ask in the comment section. I'm willing to explain. I am willing to explain. Okay. So that's it. So what happens? Now, listen to what I'm saying very carefully. Now, in these Bollinger Bands, we have something called squeezes. Now, what are these squeezes? At a point, you realize that there are price was moving normally, then all of a sudden you get an area where the three lines are so close to each other. This is one squeeze here. We have another squeeze here. The three lines are so close to each other. Now, anytime you see a squeeze, be ready for an impulsive movement or a reversal or an impulsive movement, simple and short. Now, look at this. When the squeeze happened here, where is it? When the squeeze happened here, look at the impulsive move to the downside. There's an impulsive move to the downside. Look at how price was moving relatively to this after this squeeze. Now, look here too. This was a squeeze. Now, see what happened. Price opened far below. See where price opened. They should tell you a lot. They should tell you a whole lot. You should be ready to learn much about indicators. They are very important. They're going to help you with your confirmations. You're not going to rely on it that much, but you knowing it gives you a little edge to know how the market works and what to do. So anytime you have a squeeze, let me see if I get another squeeze. Okay, we are not getting another squeeze here. It's not every day that you're going to get a squeeze, but if you get a squeeze, it's going to tell you that okay, there's an impulsive move coming soon. Now, here are all impulsive moves, but you didn't get a squeeze. It doesn't matter. But once you see a squeeze, you should be ready to look for impulsive moves to either direction. So once you get a squeeze, you can bring your RSI, you can bring your SMA, you can check them out, see where price is likely supposed to go, and do what? Join the market to that beautiful direction. Okay. So that's it about SME. One last thing, they have three lines: the middle, the down, and the top. Now, anytime price taps the top, price is the top act like a resistance. So price is supposed to bounce off of it. Yeah. So if you realize most of the time price bounces off, let me look at current price. Oh no. Coming. Look at current price. Price is bouncing off of this. So someone will want to sell to this line. It's possible, but the reason why I'm not going to advise you to sell is currently we are in an oversold market. That's why you're supposed to confirm with other things, or simply get your trade and use the indicators to confirm. Don't make trades solely out of your indicators. Make the trade and confirm your indicators. I hope people are getting it correctly. Please ask questions. Ask questions if you have questions. I'm here for you. I'm here because of you. Ask questions. Okay. So we can continue. Then finally, we are on the most important aspect, which is the fundamental indicators or the economic indicators. Now, so what are fundamentals? They are statistics on a country's economy that affects the value of the country's currency. So statistics of a country's economy that's going to affect the value of the economy. So we have types like the 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 above one. We have like the CPI, which helps for inflation, and many others. What does these do? So the CPI mainly deals with inflation. Anytime you hear CPI, we are talking about inflation. If you hear NFP, we are talking about unemployment. If you talk about interest rates, we are talking about the people who want to invest in a country's economy, GDP, unemployment rate, all that. Now, let's start with the CPI as usual. So, consumer price index. So, it's very important. It shows price of goods and services change within a specific period of time. So simply put, it tells you how much the cost of living is, whether it has increased or decreased. So it's telling you if the cost of living has increased or decreased. Simple. That's for CPI. You don't have to think much about it. It's just telling you that okay, last month as compared to this month, life has become housing, the cost of food, the cost of transportation, healthcare, education, and they're going to use to give a value for the CPI or the consumer price index. Now, how can CPI help you? Now, when you have high CPI, you are going to get inflation. Now, the formula for inflation is your current CPI minus your previous CPI divided by your previous CPI times 100. Anytime there's a higher CPI in the next month, your inflation is going to get a higher rate. Now, anytime there's inflation, a higher inflation, central banks tend to raise their rates. The reason is They're raising their rate to counter for the inflation increase. Now, anytime a bank increases its interest rate, it brings in investors. Investors want to put their money wherever their rate of interest is going to be high. Now, imagine you have $50,000 and they are telling you, a bank in Ghana is telling you that the interest rate is 10%. It means that after a certain period that you agree with the bank, you're going to get 10% of your 50,000. But imagine Togo is telling you that they're going to give you 3%. Which one are you going to invest your money in? You're going to invest your money definitely in Ghana, which is 10%, because you're going to get a higher return. So that, because of that, plenty people are going to invest in Ghana instead of Togo, strengthening the currency of Ghana. Now, when you strengthen the currency of Ghana, it means that on the forex market, Ghana is going to be stronger. So let's use the USD for example. Imagine CPI comes, USD is high, inflation rate is high, rates go up, then now the currency is strong. Any pair that has USD, any pair that has USD as the base will go up. So imagine this pair, this is having USD as the quote. Now imagine this pair, USD is strong. AUD to USD is going to fall down. Now anytime is the quote, anytime value is at the quote, if that pair becomes stronger, price is going to move to a down direction. So USD is going to basically what, move to the lower direction. It's as simple as that. Then same, when it is low, it's going to do the same thing, basically. So when the currency becomes weaker or the currency becomes stronger, price is going to move relatively to the weakness or the strength. So low CPI, the same thing. You're going to have deflation, you're going to have lower rates, and the currency is going to weaken. Then we move to my favorite, my personal favorite, which is NFP, non-farm payroll. So this particular indicator, or this particular economic indicator, will be announced on Friday, this coming Friday, I think around 1 p.m. Good. Before we even continue, let me introduce you to the indicators, the economic indicators application called Forex Factory. Now, this is how the Forex Factory in the interface looks like. What does it do? It tells you all the news coming up in the days. So this is for today. No, this is not for today. Today is 4th March. I can go back to 4th March. Today. Good. These are all the news, the economic news that happened today. Now we had the ADP non-farm payroll change. We have the ISM services. Now you can see there are 3 different colors. We have the orange, we have the yellow, and we have the red. Now they go with importance. The yellow is the least important, the orange is medium important, and the red is high importance. So every morning before I trade, I come over to look at the news to know if anything is going to affect my currency. Tomorrow there are some important economic data, but just one, that's 7:30 a.m. unemployment claims. Nothing much. Then on Friday, which is 6th March for Ghana, happy independence in advance. We have important things going up. We have NFP here, non-farm. Okay, this is not NFP. This is non-farm employment change. Non-farm employment change. Okay, and we have unemployment rate here. We have retail sales, average hourly earnings. All these are very important. Now, all these have significance or affect the currency because it has a red folder. Now, all this will be listed at 7:30 a.m. on Friday. Now, I think my time is the US time. That's I saying 7:30 a.m. I think, yeah. My time is the USA time. That's why I saying 7:30. It should be around 12:30 or something, or 2. I don't know if my time is right. But yeah. So I need you all to download Forex Factory. Get Forex Factory on your devices. You're going to be needing Forex Factory because when you're trading and there is news and you don't know, you can be on the right channel, right path and still lose. So we are trying to fight against that. Now, get Forex Factory, the red folder. Just tap on the folder here and learn more. Average hourly earnings. What does it measure? A change in price business pay for labor, excluding the farming industry. Good. So when your actual is greater than the forecast, it's a good currency. You can learn much from Forex Factory. Just get the app. Try to get at least 5 minutes a day. 5 minutes a day, you're going to understand it. 5 minutes a day with indicators. 5 minutes a day with Forex Factory. You're going to get everything. You can do everything you want if you are determined to do it. Please sit down and try to do it out. So yes, that's it about Forex Factory. Now let's continue with our non-farm payroll. So what does non-farm payroll deal with? So it deals with the number of employed people, excluding farmers and government workers. Simple. People don't normally add the government workers, but yes, NFP measures the number of new jobs or the number of or the number of employed people, um, excluding farming industry and the government. So what does NFP tell you? So imagine you realize that um, the non-farm payroll is low. What does it mean? The number of employed people are very low. Now, if a country has low employed people, what does it mean? It clearly means that the currency is not good enough to stabilize the people, to help them get jobs and gain income. So therefore, people are not willing to invest their money in a country that cannot help its citizen gain money. If a country can't help its citizen gain money or gain an expected amount of money, it means that the economy is not moving upwards. You are in a country, you have your people suffering. What shows that if I invest, I'm going to gain more money. So when you have low NFP, it normally weakens the currency. And when you have high NFP, it makes the currency stronger. So employed people for this month was very high. It means that our work load is going to be high. Our revenue is going to turn up to be high. So if investors invest into a particular thing, they are going to gain more returns. So people invest in countries that have high NFPs, like the United States. For the past few months, it has not been getting a higher NFP. I think it has been reducing slightly, or sometimes you get the same value, but it's not really a big deal because the United States is the United States. So high NFP, strong economy, USD strengthens. That's how simple it is. Low NFP, weak economy, USD weakens. Then our last thing on our list is the interest rate. We've basically spoken about the interest rate already when we're talking about CPI. So what is interest rate? When the bank chooses to say, okay, if you give me this amount of money, I'm going to give you a percentage increase after I use it for whatever I want to do. So in case a bank like Ghana's, I used 50,000, they tell your interest rate is 10%. You're going to prefer to invest in Ghana as compared to investing in Togo, that is 3%. So higher rates is going to attract investors. No one is going to see 10% interest rates and 3% interest rates and going to pay the 3%. It's not going to happen unless there's something hidden and you know the hidden fee behind that. So higher interest rates attracts higher investors and the currency will appreciate or will gain power. Then the lower rate is the opposite, reduce investment returns and the currency would depreciate. Now, one last thing, when it comes to interest rates for traders, it's not about the percentage you get. You took 50,000, you're going to get 10%. No, for forex traders, that's not what we use. For forex traders, it comes to the country's bank able to lend money to commercial banks. So the country's main bank is able to lend money to small banks. So imagine it this way: you have money, you want to start a company, but you don't have that much money to start. You need $2 million. You have $1 million. How does this interest rate act? You want to go to a bank where they can lend you $1 million to add to your $1 million to trade. But if you go to Benin, because their interest rates are low, the central bank cannot give the low banks or the commercial banks enough money so that they will lend to you. So you go to a country that the interest rate is high, or a country where the central bank can lend big sums of money to commercial banks so that you can go and loan from the commercial bank. So that's what is actually happening in the forex market. You want, when interest rates increases, we understand it that okay, the central bank has given chance for commercial banks to take large chunks of money from them so that they can also what loan it to investors. So high interest rate is going to attract more investors because now the central bank can loan big amount of money to the commercial banks. So yeah, so high interest rates attract investors, currency appreciates, and low interest rates reduces investment returns. And what happens? The opposite, which is currency depreciation. Now, what's the summary for all this? Technical indicators help analyze price trends and momentum. Fundamental reflects economic performance. Combining both gives a complete trading perspective, but it's very um, difficult to combine both. Very, very difficult because normally when the economic one happens, it has spikes. They move very fast. They have quick movements that people don't even get time to play straight. Sometimes when economic indicators happen, you can't even place your trade. But with having working with EC market for over a year now, I've never had that issue placing a trade during news and um, 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 the trading place is quite unreasonable to me. So remember, indicators guide you. They don't guarantee results. I've been saying this throughout the whole session. They don't guarantee results. Don't base your whole life on indicators. Get the trade, confirm with indicators, or confirm with indicators, then try to make meaning out of it. But I'll prefer you get a trade before you try bringing indicators into the equation. Now, one last thing about the economic data. Um, Always pray you get CPI. I'm not saying pray, but if you get CPI before NFP, it's a win for you because you can then predict what your NFP is going to be. Now, your CPI, in case you got a high CPI, means the inflation is going up, interest rate is going up, more investors. Now, investors are not going to invest in something that has a low non-farm payroll. I'm not going to invest in a country that has small amount of citizens working. Yeah. So when you have a high CPI, high interest rate, currency goes up. The next few days are going to get your NFP. You can use that data from CPI to determine where your NFP is going. So in NFP, if you had your previous CPI to be strong, currency is strong, it means you are going to wait for your NFP and you're going to believe that your NFP is also going to be strong because of the interest rate. Now, family, thank you for joining today's session. I'm very happy um, for today's session. We didn't have any network issues today. The session has been smooth. Once again, this app is called Forex Factory. Get it on your devices. Forex Factory. Please get Forex Factory on your devices. Um, um, try and trade. Try and trade. At least 30 minutes a day is going to help. I know you go to classes and all, but try and trade at least 30 minutes a day. Once again, welcome to DanTrades Mentorship. We had a wonderful session. Thank you all for joining and have a wonderful weekend.